Today, when you look at those bright screens, at those colorful charts updating in milliseconds, everything looks so clean, so organized, and so systematic, doesn't it? The candlesticks are lined up in perfect order, moving averages follow the price, and oscillators show you overbought or oversold zones. But in the era when Richard Wyckoff developed this method and unraveled the market stitch by stitch, back in the early 1900s, the market was absolute chaos. There were no RSI indicators, no automatic stop-loss orders, and no software to hand you a strategy. Everything was flowing in the moment. In smoky trading halls, prices printed on paper ticker tapes, the noise, the shouting, and the rawest form of human psychology were all mixed together. It was right there, in the middle of this chaos and noise, that Richard D. Wyckoff realized a tremendous truth, one that remains valid 100 years later, ticking like clockwork even in the age of algorithms. The market is not actually complex. It's just that most people are looking at it from the wrong perspective. Wyckoff pushed aside the question everyone asked in panic, what will the price be tomorrow? Instead, he asked a much more vital, much more fundamental and engineering-like question. What is happening right now, at this very second, and what does it mean mathematically? In this video, we will discuss not just Richard Wyckoff's philosophy, but his measurable, clear, and rule-based technical analysis structure known as trade secrets. If you are ready, let's learn not to predict the market, but to solve it like a formula. First, to truly internalize Wyckoff's approach, we need to engrave his famous metaphor regarding the market into our minds, the concept of the composite man. Wyckoff advises us, do not view all those big players, banks, hedge funds, and market makers as independent, randomly moving parts. Think of them as a single organism, a single mind, a massive operator. This composite man, the secret master of the market, is not actually your enemy. If you learn to read his footprints, he is your greatest guide. So, what does this operator do? He actually works with a very simple business logic, but while doing so, he uses mass psychology as a weapon. When everyone is selling in fear, when headlines scream, "We are ruined, it's over," he quietly accumulates. That is, he buys when the goods are cheap and when no one else wants to look at them. Conversely, when everyone is buying with enthusiasm, when rocket emojis are flying on social media, he distributes what he holds, but he never wants to leave a trace while doing this. He doesn't raise the price sharply while buying so his costs don't increase. He doesn't drop it immediately while selling so he can offload his goods at the highest price. The power we call smart money today is the very entity Wyckoff defined 100 years ago. Then the real question is, how do we follow the footprints of this invisible giant? Wyckoff's first axiom, his constitution, is very clear. The market must be judged by its own action. What does this mean? News, company balance sheets, CEO statements, or rumors are not analysis inputs. Wyckoff puts a single data set on the table: price, volume, and time. His technical analysis is essentially a multiplication operation: price times volume times time. If these three are not in mathematical harmony with each other, the signal you see on the screen is invalid. So how do we measure this harmony? This is where Wyckoff's most numerical, most critical law comes into play: effort versus result. Wyckoff does not ask for relative interpretations here. He asks for a direct comparison. The formula is simple. Volume is the effort spent, the fuel. The distance the price travels is the result obtained. Let's concretize this with Wyckoff's own logic on a chart. Let's say in a previous upward wave, the price increased by 3% and did so with an average reasonable volume. Now you look at the chart, a new upward wave is coming. There is a serious increase in volume bars. 2 or even 3 times the previous volume is being traded. So, the engine is roaring, the effort is massive. But you look at the price, the candlestick remains tiny. The price could only rise by 0.5%. Wyckoff does not ask, "I wonder what will happen." Here, he gives his final verdict. This is a weakness. Because despite the massive effort spent, the result obtained has diminished. This proves that the volume is not an appetite for buying, but on the contrary, big players are selling with passive orders, seizing the opportunity of the rise. That is, they are doing absorption. What we call divergence in modern technical analysis today is actually this simple mathematical disproportion of Wyckoff. Let's take this rule a bit further. There is a very harsh technical rule that appears repeatedly in Wyckoff's tape-reading notes. If volume increases but price does not advance, supply is present. This is not an interpretation, it is a determination. If the price cannot advance at least as much as the previous wave, but the volume is higher than the previous wave, smart money is dumping goods into the retailer's lap here. When you see this structure, it doesn't matter how good the news is. The technical reality is the presence of selling. So how do these structures evolve into a trend or a reversal? Markets do not move randomly. Wyckoff divides these cycles into accumulation, markup, distribution, and markdown. Everything begins with accumulation, the gathering process. Big players are patient when collecting an asset from the bottom. They don't want the price to skyrocket. That's why they trap the price in a certain horizontal band, a narrow range. Wyckoff sees this horizontal process as a cause. His famous cause and effect law comes into play here. This law tells us the magnitude of a movement is proportional to the preparation time. The longer an asset is stuck sideways, the more energy it accumulates, meaning the bigger the cause, the bigger and longer lasting the result, or the trend, will be when it explodes. Wyckoff quantifies this with the point and figure method. However many columns have accumulated in the horizontal area, the potential of the explosion is that great. So, for a Wyckoff trader, there is no boring sideways market. There is a preparation phase where energy is stored and the target grows. The most crucial, most deceptive, yet most profitable moment of the accumulation process is the event we call the spring. Most people think the spring is just a bear trap. However, for Wyckoff, a spring is not a random wick. It is a set of conditions, an if-else code. The strict criteria Wyckoff sets for a movement to be considered a valid spring are as follows. First, the price drops below a previously defined support level. Second, during this drop, volume increases or remains constant, meaning there is panic selling, stops are popping. Third, and most importantly, the close must absolutely return inside the range, above the support. The price cannot remain permanently below. But the job isn't done here. The Wyckoff trader does not hit the buy button immediately. Because Wyckoff's absolute rule is, a successful test is one with diminished volume. This brings us to the sharpest filter of the method, the concept of the test. After the spring, the price comes back to check, or test, that bottom level again. Here, Wyckoff takes his eyes off the price and fixes them solely on volume. If during this return, the volume is not significantly lower than that initial drop, if the volume has not dried up, the test is invalid. Wyckoff says, if the volume hasn't dried up, the selling hasn't finished. In other words, no matter how beautiful a pattern looks, if there is no volume confirmation at the test stage, the Wyckoff trader does not enter that trade. What protects you from loss is not the shape of the pattern, but the confirmation of the volume. Okay, let's say the test was successful, volume dried up, and the markup, or the uptrend, began. How do we know we are in a trend? Just saying highs are getting higher is insufficient for Wyckoff. He ties the definition of a trend to conditions. In a healthy trend, while the price makes a new high, volume should not be less than the previous peak. Demand must remain alive. While the price pulls back, meaning during a pullback, volume must absolutely drop. And the most critical technical detail, after the pullback, the price must remain above the previous low level. If the price is making a new high but volume is dropping, Wyckoff doesn't call this trend continuing. He says trend is nearing its end. This distinction is a vital nuance that saves you from buying at the top. And every good thing, every party has an end. Distribution. This is the most dangerous, most insidious place in the market. Because everything looks great. The news is positive. Everyone is talking about that coin or stock. But the Wyckoff trader returns to that simple math when looking at the screen. The price struggles to go up, volume breaks records, but the price just cannot break away and go. Effort is maximum, result is minimum. Wyckoff's harsh warning rings in the ears here. Volume increases but price doesn't go. Selling exists. This is the moment the operator transfers the goods in his hand to retail investors using their enthusiasm. Wyckoff says, the public buys after a rise and sells after a decline. The operator acts in the opposite manner. Distribution is where this tragedy is staged. The final curtain rises and markdown, the decline phase begins. At this point, asking, Why did it drop? What news came out? Is meaningless, because the cause was already formed at the top, in that distribution zone. Wyckoff emphasizes a painful truth here. The market owes you nothing. Declines are just as natural as rises. The important thing is not to be stubborn with the market, but to accept the direction of the trend and the intention of the operator. To summarize the Wyckoff method, in this system, there are no hidden indicators, no magic parameters that no one knows. The real secret is reading the divergence between volume and price within context over and over again. Wyckoff doesn't tell you, draw this line. He makes you question, prices are dropping, but why is there no selling volume? Or, prices are rising, but why is it struggling so much? The answers you give to these questions should not be feelings, but as clear and measurable as the height of the bars on the chart. Also, remember, the Wyckoff method is not just a chart reading method, but also character training. Wyckoff clearly states, if there is no discipline, knowledge is worthless. Impatience, entering trades early, buying at the top with the fear of missing out. These are not faults of the method, but character faults of the trader. The Wyckoff trader sees doing nothing as a trade, as a position. Waiting in cash is being a hunter waiting in ambush. Today, algorithms may have taken over the world. Bots may be executing thousands of trades in milliseconds. However, there is one thing that has remained the same for 100 years. Big money, that composite man, still needs one thing to open and close positions: liquidity. That means you. Accumulation is still done in secret, distribution is still presented with the most enthusiastic news. Starting tomorrow, look at your charts with these eyes. Don't just concern yourself with what the price is, but with how much fuel, that is volume, was spent to get to that price. Listen to the whisper of the volume, because in the market, price can lie, but volume never lies. Wyckoff's legacy and true market literacy are hidden in this honesty.
Thank you for watching our video. In the next episode, we will examine the journey of another legendary trader. Don't forget to subscribe and turn on notifications. For more content and strategies, you can join our Telegram channel. The link is in the description.